we have a tradition every time we close an asset, we choose a charity and we make a donation to that charity. And I actually do a second round of fundraising after the deal closed. And I ask, anybody who touched the deal, anybody who made money from the deal, anybody who invested in the deal, I ask everybody to make a donation.
Welcome to the Going Long Podcast. We're back once again to continue to help to educate you so that you feel much more comfortable as well as confident investing beyond your backyard. And yes, I am your host, Billy Keels, and I am really looking forward to you and I sharing today's conversation. You know what? Because it's going to be really, really awesome. Today is a really awesome conversation, especially if you want to know how to go to multiple locations, scale your business. If you have had previous financial services industry background in a corporate role, then this is you're really going to love this one. Going from corporate to building your own business and being able to do that through actively and passively investing. So, but before we get to that, I just want to make a couple things known once again. So as you know, our podcast continues to move up the charts thanks to you, and you're actively downloading and listening to the episodes and also taking all this wonderful information and putting it into practice. And you also, because you are actively leaving your honest written reviews as well as ratings. So if you haven't had a chance to do that yet, just take a second to leave your honest written review as well as a rating. We've got a nice little video here. Makes it easy for you, especially if you're on the Apple Podcast platform, just to leave an honest written review as well as a rating. And we would really appreciate that because we're also able to continue to attract amazing guests that are bringing you more and more value. Speaking of which, some of you have also mentioned that you can't find some of the episodes on some of the different platforms. But you know what? We've made it really simple for you to find every single episode. Like if there was a special one that you wanted to listen to, like right in the very beginning, you can find every single one at billykeels.com. When you get there, just go to the podcast tab and you can find every episode. Audio version, video version, they're all there. billykeels.com. Find the podcast tab, upper right-hand corner. And then from there, you will be able to listen to every single or watch every single episode. So they're all there. With that stated, I know a lot of you are also accredited investors and you are wanting to find out more about our accredited investor club. If you are interested, then all you need to do is send me an email. I'm making it really, really simple. Send that email to aiclub@billykeels.com. Get you to know more about what we're doing, get you onboarded and things like that. So just go to aiclub@billykeels.com and we will help get you on board. So with that, listen, today's guest is absolutely amazing. I mean, done so many different things, grew up in a family that was around real estate, but spent a lot of time in the financial services industry, in the corporate world. So spent a number of years, I think it was about 8 years that she spent in the corporate world, decided to leave, went back to her roots, which was around real estate because she saw her parents doing that, got into property management, got a really good insight there. And then from there had a really nasty tax bill that she and her husband got. And after that, she decided she needed to take some action, do some things very differently. And so she decided to do that and really dive into the real estate aspect and started doing that actively, has also done it passively, and is now helping other investors to find the right locations and be able to invest capital, help to right-size their tax responsibilities or obligations, and is really interested in sharing her story so that you don't actually have to go through the same painful kind of experience that she went through. So I know you're going to really love today's conversation with Veena Jetti, and we're going to get to that conversation just after this. Whether you're an active investor or a passive investor, you really like your day job and you want to continue to go into your day job every single day feeling better, knowing that you've created the right options for yourself. At the same time, you just don't have enough time to really get your head around, spend all the hours investing long distance. Well, one way or the other, over the last number of years that I have been investing long distance, I've really understood a number of the major mistakes that you should avoid if you want to get to creating the right options for yourself much faster and being able to create more income sooner. And if you want to do that, if you want to understand more about that, I've made it really, really simple. You can just go to billykeels.com/7 mistakes to avoid. You can learn all the things that the 7 major mistakes that I've seen over and over again that I want you to avoid. Once again, you can go to billykeels.com/7 mistakes to avoid. So you know what? If you want to know how to get your Vive on in the long distance investing game, then guess what? Today's is a conversation that I promise you're going to want to listen until the very the very last word today, I promise. You know why? Because today's guest not only had the good fortune of growing up in a family surrounded by real estate, I'm sure she got lots of insight there. She also then decided to start a corporate career in the financial services industry. And I'm sure that there was a whole lot of learning that was going on there as well. But then decided after that to go back to her roots and actually got involved with companies with property management. And I'm sure she's going to tell us a lot more about that. And then she went on to found a couple of companies, but most recently, Vive Funds. And it gives me great pleasure to welcome to today's conversation, Veena Jetti. Veena, welcome to the show.
Hi, thank you for having me. That might be the best intro that I've ever had on a podcast.
Oh, here we go. You're already starting out with flattery. You know what? We're already going to introduce you back. No. Thanks so very much. Well, you make it easy because you've done so many different awesome things. And I'm super, super looking forward to the Going Long family, getting to know much more about you, diving into learning about your experience, and also so that you can help them move forward even faster. So, and as you know, Veena, like everybody's going to get the same 5 questions. You are going to get the same 5 that the previous guests received, and the guests after you will receive. You're going to get 2 in the beginning. You're going to get 3 in the end. And then in the middle, the entire Going Long family is going to get a chance to know you and learn a lot much more from you. So thing is, I want to jump right in and just really help the Going Long family understand, where do you live in the United States?
Yeah, so I'm in just north of Dallas, Texas, in Frisco, Texas, which is a very large growing suburb of Dallas, Texas.
Really awesome. Yes. And it is definitely a place that is flourishing, growing, and you're in a great place right now. So with that, I also want to get us started out with some positivity. Help us understand, what's the most positive thing that's happened to you in the last 24 hours?
Oh my gosh. Okay. Anybody who has young children will understand why this feels like such a big win. But I have twin daughters that are 2.5. And one of them has decided sleeping through the night is not for her anymore. And so last night she slept almost through the whole night and did not wake up till 5:45. So I got a full night's sleep. And so I know it's not business related or investing related, but it really is the most positive thing that happened to me.
So here's the thing, and I do this every once in a while. And so I thank you so much for sharing that positivity. And yes, having had 2 young children, and now they're about 10 and 12, so they're a little bit older now. But I absolutely know what you're talking about when you get that full night, especially because I watched my wife. She didn't really sleep a lot when the kids were really, really young. And so everybody, if you want to jump over and see the video version, you can actually see Veena. She is just like with this huge smile ear to ear. And so great night's sleep. And so congratulations. And yes, life is more than just real estate. There's so many different things that are going on. And I appreciate you sharing that with us. Yes. So, and here's the other thing, Veena. I give myself this really impossible task of trying to tell your entire backstory in like 6.5 seconds. Never going to happen, right? Because you've done so many things. But the thing is, I would love for you to share with the Going Long family your own backstory in your own words. And also, if you could do us a favor and maybe talk about some of the major decision points that you've made to get to this point in your journey. And then afterwards, we'll see where the conversation goes from there.
Sure. Yeah. So like you said, I grew up in a real estate family. My mom is actually a very successful real estate investor. Her and my dad actually retired early from their portfolio. And so I graduated college with my degree in finance when I was 20. And, I knew everything back when I was 20. And, as you get older, you realize how much you definitely do not know. But back then, my mom thought, okay, now Veena's going to come and work for the family business and it'll be great. And I was like, no, I have a degree. I'm going to go out into the world and get a job and do something radically different. And so I went and worked in corporate real estate and made a lot of money for somebody else. Ultimately, in 2012, I left my corporate career mainly because, my husband and I paid taxes for the first time married, and I did not expect to pay as much as I did in taxes. And so I called my mom. I was like, Mom, what just happened? And she's like, you need to be in real estate for yourself. You can get real estate professional status, and you need to be investing in real estate where it's a very tax efficient investment. And so ultimately, I ended up leaving my corporate career, taking a lot of valuable lessons, and then starting to invest for myself. And that's really how I started in the corporate world. So the major decision points were, 1, not going to work for the family company. 2 was leaving corporate America to start my own company. And then 3, the third and kind of the crux of the scale I've experienced is in taking in investor dollars, because initially I didn't take in any investor dollars. I only invested for ourselves. And so that's really how we got to where we are now. Our portfolio has, anywhere from 5 to 600 million, a little over 600 million at the moment. We're disposing of assets, so that'll change, but we've transacted on over 600 million in my company.
Fantastic. So there are so many different ways we could take this conversation, and kind of when you finish with the 600 million in assets under management. And this is definitely a very dynamic and fluid type of marketplace, right? With lots of inefficiencies, which is probably one of the things that you with the finance background was able to positively take advantage of. But the one thing that I'm sure that people are like, well, hang on a second. If she started in real estate, why in the world would she go do something else, but working in real estate for somebody else and then eventually go back? So with that kind of as a background, how difficult was it for, I don't know if you've spoken to your parents about this, but if they were already in the real estate space, for them to actually allow you to kind of fly away to do something which is pretty much the same thing that they were already doing?
I think my parents knew who I was. And so I don't think it was actually really that much of a surprise to them. They actually raised my sister and I, so it's just both of us. They raised us to be very independent and to, the world is your oyster has kind of been the messaging they've always given us. I'm the daughter of 2 immigrants, and they left their home country with no internet, no cell phones, to a place they had never been to give my sister and I a better opportunity. And I think that what I have done and the steps I've taken really have been in the spirit of taking what they've done to the next level and growing what they've accomplished. So they're very supportive. They're very happy. Now they're completely divested from their portfolio and 100% invested with me. So, no pressure there.
I was just going to say, absolutely no pressure there, kind of tongue in cheek. So here's the thing, which I think is fantastic. So you had that background, then you went and had, college education that was really around the finance aspect of things. Mm-hmm. But you talked about this kind of painful moment that you and your husband had jointly paying the taxes. But what was it that, aside from that made you decide that, hey, listen, you really wanted to get more involved? Because one thing is to kind of help with some taxes or not paying so much in tax on one side. But the other thing is really deciding hey, listen, I want to actually continue to move more and more of my time, energy, and effort in this whole real estate or investing space. What was it that moment for you that pushed you in that direction?
Yeah, so my corporate career was in real estate as well. I was on the management team for $1 billion, now it's valued well over $1 billion asset in DC. And I really learned a lot from my corporate career. I made a lot of progress and growth from looking at their portfolios. I was in the real estate market back after the last crash in 2008, 2009. I was in real estate. And I remember what it was like going through that downturn with a massive portfolio. And so for me, really, I'm just not a good worker bee. I don't want to report to somebody else. I don't want to be, going in from 9 to 5 days a week. It's not a lifestyle that really fits with who I am. Now, the irony of it is I'm willing to work 100 hours a week for myself so I can avoid working 40 hours a week for someone else. I think Warren Buffett said that. And that's really the spirit of what I like to do. And I also like to be able to grow the company with the vision that I have and with the characteristics and morals and ethos that are important to me. And so for me, having that control and being able to establish that was really important. And then also, there's not a whole lot of women, and there's certainly not a whole lot of women of color in the private equity space that I'm in. And for me, it's really important that my daughters see that they don't have to choose between having a family and having a career, or they don't have to have a limitation on being in spaces that are typically dominated by males. And so that was kind of the other side of the coin for me. But all those things coupled together really ended up being a great decision. Obviously, in hindsight, it's easy for me to say that now.
Well, I mean, I don't know if it's easy for you. It's probably easier for you to say it now. Not that it's been without it's, I mean, nothing is perfect, right? And so I love what you talk about, because this really is a lot about the importance of control. When it was the Warren Buffett thing that you said, you'll work 100 hours a week for yourself to avoid 40 hours for somebody else. But being able to have that clarity and understanding what it is that you are really interested in, what it is that makes you get up in the morning is really, really important. It's something that many times it takes someone 45 years of their life to realize once they're 65 with that watch that, oh, hang on a second, I probably could have done some other things. And I guess maybe with that as a background and understanding that you also want to have that role model for your daughters, 2.5, which is awesome. One of the things that I think would be also interesting to know is, that this podcast, one of the things that I've learned, right? And I read a lot of books as well. And I read a lot of the popular purple books. And then that took me down the rabbit hole of watching a lot of videos on YouTube. And then I listened to podcasts and all that kind of stuff. And it always seemed that people were either directly or indirectly saying, hey, listen, when you go into real estate and you want to be a landlord, you need to buy the property that's in your backyard. I fundamentally don't believe that, because I live in Barcelona, Spain, and I've been investing exclusively in the United States for the last 8 years, right? And so I'm always just curious, because this is like helpful to a lot of other people that are getting into this mindset and understanding about long distance investing as a tool. Is what was it also that motivated you to go against the grain of popular decisions and buying in your backyard to say, hey, listen, I actually want to go and look in multiple locations, different states, hundreds or thousands of miles away, in order to help you get to your goal and your dreams, and now doing that for other investors? What was it that gave you the impetus to invest long distance?
Yeah, so I think that generally speaking, most people, like the average person, has a very poor understanding of risk. And I think that the more sophisticated you are as an investor, you can weigh the risk of investing where you happen to live versus where you are going to make money. So there's that saying in real estate, live where you want to live, invest where you make money. And that for us is absolutely true. So I happen to live in a market that we do invest into, and it's a very hot market. But as an example, my JV partner, she does not live she's bi-coastal, and neither of the locations she's in are areas where we would enter anytime in the near future, because it doesn't fit our business plan and our model and where we found success. So, this is the 21st century. There's planes you can hop on, and it's easy to get on a flight. I mean, I've booked flights driving to the airport because we have to. And so I think that when you limit yourself to where you live, you really limit the potential to go into the best deals. And we're by nature very conservative investors. So for us, the risk that we try to mitigate isn't with the distance or the location. The risk we try to mitigate is in the types of assets we're buying, where they are from a risk perspective in the market cycle itself, what the tenant base is like, what our ability to actually operate the asset is like. And so there's a lot of different tools available. And especially as the world went through this pandemic in 2020 and 2021, a lot of things have shifted to be virtual, where you don't need to be boots on the ground. And so I think the more sophisticated you are, the more you can assess the risk of investing in other locations that may not be in your backyard. And, if you live in a great location, awesome. Like my sister is a minority partner in my company. She lives in Atlanta. She lives in Beaufort, Atlanta. And we just bought an asset there for $81 million in Beaufort, 10 minutes from her house. We didn't look for it because she lives there. It was a happy accident, but we bought about $250 million in the last 13, 14 months in the Atlanta market, because it's a great market and she happens to live there.
And so this is one of the things. So number one is not being able to limit yourself to a specific geographic location. And when you are able to leverage things like technology, I mean, it's kind of funny. As we talk to one another, I've been using Zoom for the last 7 years, and people are like, with the pandemic happened, it was like, oh, hang on a second, you can actually talk to people and build relationships, and you don't have to actually get on a plane and fly and here and go everywhere. Where it's, the technology is now an accelerator. There are moments, and I'd love to get your take on this. Technology can take you to a certain point. I'm going to make a wild assumption that when you make when you bring the $81 million asset into your portfolio, you're not going to probably do that exclusively over Zoom or FaceTime. Would that be accurate?
Yeah, I would say we'll probably go there a time or two in person. Yeah, no, we're not doing it exclusively. But, what's interesting is in the pandemic, because we operate large multifamily assets, we've seen a lot of shift toward technology. So some of the things we do now that we didn't do pre-pandemic are we do virtual tours. So you can set up a tour and be completely contactless. So those are really interesting changes that I think were coming anyway. They just, like you said, were accelerated by the pandemic. So.
Which is one of those things which is fantastic. So, one of the other things that I would love to get your take on, right? Because as we do these types of interactions and relationship building and accelerating, and we do that in a way that is using technology, sometimes online, offline, et cetera. But like one of the things that people that are in high wage roles sometimes is like, okay, great. I love doing the job that I'm doing because I'm an IT sales executive or I'm a lawyer or whatever, but I don't know how to actually find the people that are helping, or I don't know necessarily the questions to ask to vet someone who is maybe not necessarily a syndicator, but someone who is an operator. So what would you say to those people where they're trying to figure out what's the best way for me to actually go out and vet someone that aligns with me and is also going to be a good steward of my hopes and dreams, which I call wire transfers of capital?
Yeah, that's a good question. And I think that that's the hardest part for a lot of passive investors that start getting into this space. The best way to do it is from referrals from other friends and family, but sometimes, especially on deals like ours, where there's a lot of competition to get into them because we have so much capital and we don't do very many deals. Sometimes some of our investors kind of keep our recommendation close to the vest so that they can get into the deals without diluting the pool, right? So, but that's the best way to find somebody. But also, I meet a lot of investors from doing podcasts like this. I speak on a lot of stages or conferences. But really, this is a relationship business. That I think is number one. Number two, set up a call with the person that you're interested in investing with and understand what their business model is, understand how they view risk, and make sure it's in line with yours. As an example, our deals, we're very conservative investors. And if you look at my deals compared to other deals in the market, ours are just going to be lower projected returns because we go into less risk deals. But you might be an investor that's like, no, if I'm going to put money in this, I want to triple my money. That's pretty much never going to be a projection I put out to investors. So you want to make sure that you are aligning yourself with the right sponsor. If you're looking for something that's just, down the middle of the road, then our deals do make sense. And about 70% of our database are physicians, and it makes sense because they're also typically, as an avatar, they're more conservative investors. And so you need to find a sponsor that aligns. And then I also think that asking about how the incentives are aligned is really important, and understanding that when you're making an investment, because you want to make sure that you have a sponsor who's incentivized to do well on your asset and who's incentivized to perform, but not so much so that they're incentivized to go to the next deal.
And I love that you just mentioned that, Veena, because a lot of times people will hear that, but I mean, you've got massive experience. So I would love for those, these high paid IT sales executives that are listening and watching, when you say, okay, alignment of incentives, because that means a lot of salespeople are like, oh, hang on a second. All right, I want to make sure I understand this. So could you give us an example of what that sales executive or that doctor or lawyer should be looking for in terms of that alignment of interest?
Yeah, there's so many different ways to structure these deals, right? You can structure it with what's called a prep or a preferred return, which is how we structure our deal. So what that means is, let's say you were to invest into my deal, and let's say you put $100,000 into my deal. And these are totally for educational purposes. These are not actual numbers.
So here, I'll just say that again. Well, so also too, the entire Going Long family, as always. So Veena is going to share an example with us. This is not by any way, shape, or form something that is real. It's just, she's giving us this example so that you understand what to listen for when you're trying to understand if what you want out of a potential deal and what the sponsor is doing, that they're aligned. So the incentives are aligned. So go right ahead.
Our attorneys will be very happy that we said that. So let's say you put $100,000 into a deal that I have. We typically structure with what's called a pref return or preferred return. So let's say the preferred return is 6%. you would get the first 100% of cash flow from this asset until you got $6,000 back in a year. After that, we then take any cash flow above that $6,000 and we say, okay, you're going to get 70% and I'm going to take 30%. That's called the promote or carried interest. So on the 70%, you're going to take all 70% until we hit a certain metric or hurdle, which we set it to the IRR. So let's say it's at a 12% IRR. So that means once you get your 6,000, then you get 70% of cash flow. Then as soon as you hit a 12% IRR, then we go to a 50-50 split. And the reason that we structure it that way is because it protects investors from downside risk, but it also allows us to get paid more if we overperform. And so you're getting the first 6%, so that 100% goes to you. The 70-30 split is when we're performing. And then if we perform really well, then we start getting 50% of that instead of just the 30%. And so that's what I mean by alignment of goals, because you want me to perform as high as possible, and we want to perform as high as possible. And then the other thing that we do too to align with our investors is, and our attorneys really hate this, but we put into our documents that if we're not meeting our investor returns, then we will waive, defer, or reduce our fees. And we do it because, our attorney said don't do it because it puts you in a box and then you actually have to do it. And I'm like, okay, well, we would do it whether it's written here or not. So let's put our money where our mouth is. And I don't think a lot of sponsors do that. I haven't seen any other documents that do that just yet, but hopefully that's going to be something that starts happening more and more because I think it's important. And we also co-invest with our investors. So we invest very significantly into our own deals. And I think that's a good question you can ask right out of the gate is, are you investing in this deal personally? So both my JV partner and my family invest very heavily into our own deals.
And so that last point. So first of all, just being able to get clarification or a specific example, right, that you created for us in terms of being able to understand the alignment of goals. And so, especially a lot of our salespeople, I'm sure, like, okay, cool, like I really get that. Veena, thanks so much. Yeah. That was awesome. And then also, too, one of the things I was actually just speaking to someone earlier today, and we were talking about the whole like, are you actually investing your own capital in this particular project? Where some people were like, well, yeah, but if you're syndicating it, you're putting it together. Well, why should you do that? I'm like, well, because it's just good practice, right? And so it doesn't mean that you have to do it, but I'm also in that kind of similar camp in that if I'm going to ask someone else to do it, then I should probably put my own money where my own mouth is. So, wow, don't you just love this conversation? This is amazing. This is fantastic. And so just really quickly, I just wanted to remind you, for those of you that are looking to create more options for yourself, get there faster, and do that with long distance investing, make sure that you go to billykeels.com/7 mistakes to avoid so that you can avoid all those mistakes, get to your goals faster and sooner. Once again, that's billykeels.com/7 mistakes to avoid. Now back to the conversation. With that, one of the other things that I do want to just kind of that I want to touch on, because I know that this is something that's also very important for you as you continue to go out and not just add value to the marketplace, meaning bringing new opportunities to people who are looking to invest their dreams, their goals, their hopes, and through capital. But also you one of the things that you also are really big into is philanthropy and being able to give back. And so I would like for you to talk to us a little bit about why is that, or not why, but necessarily kind of like where is this also come from for you to have such a strong desire to get involved in and lead philanthropic ventures?
Yeah, we were raised that way. My parents instilled in us the value of giving back. And, it's important to me too, because we have so much. We've been very blessed and very lucky in a lot of ways to be where we are. And so I think that when you have this much, it's your responsibility to take care of other people and to, it could have been any one of us, right? Like we might have ended up in a worse situation and someone would have needed to help us out. So for us, we have a tradition every time we close an asset, we choose a charity and we make a donation to that charity. And I actually do a second round of fundraising after the deal closed. And I ask, anybody who touched the deal, anybody who made money from the deal, anybody who invested in the deal, I ask everybody to make a donation, whether it's $5 or $500 or $5,000 doesn't matter, but I ask everybody to make a donation. And so we try to pick something that's kind of relevant or close to us at that time that we close the asset. And so it's kind of a fun tradition we have.
Well, and that's fantastic. And then also too, that builds momentum, and it also helps to attract those investors that also want to be a part of the different philanthropic ventures that you're also a part of. And so I think that's also something really important to also highlight, and being able to give back not only just your time, but also your capital, and being able to build communities of people that are also interested in doing the same things.
Yes, absolutely.
So you, we mentioned before that you've founded multiple companies, right? Yourself and with others and things like that. And I kind of started off the beginning with our conversation talking about Vive. So maybe you want to talk to us a little bit more about what you are doing, what the inspiration was as well for starting or founding Vive Funds.
Yeah, so I actually rolled out Vive as a more solo venture where I can kind of be the dictator instead of a democracy. And I didn't realize how much I would love it, but I really love it. This is really for me. So I rolled it out mid-COVID. And the reason I actually rolled it out, the catalyst for it was I always co-invest with my investors into my deals. And I really needed to have just solo control over what we were going to be putting into the portfolio or not, because of how significantly we're investing into our deals. And so that's kind of how Vive was born. My sister really came on as a minority partner, but obviously she grew up in the same real estate family I did. But she really does a lot of functional support on the back end. So she's, definitely not so much in the forefront of the company. And she handles a lot of things that I can't hand off to, an employee necessarily, but I need someone that's trusted who can handle the demands and the pressure of our job. So that's really how Vive started. I did not expect it to grow as fast as it has. And I'm hoping that, in the coming years, we continue to grow and multiply and get bigger. But it's been a total labor of love, a lot of sacrifice, a lot of uncertainty starting through COVID. So.
Yeah. And so, and this is one of those things where you mentioned before, and now you're coming back to it again. It's really about taking it to the next level. So it's one that you've seen your parents in this real asset world. That's one of the things. I never grew up, I had no idea about real assets or any of that kind of stuff. I grew up, if you save money, that was investing. And so then, but coming back to you, what I was mentioning is, this must be fantastic because you're so focused on being able to take it to the next level. You talked about your parents, you talked about your twins. And as you started this labor of love during the pandemic, kind of where do you see things going in the next 6 to 12 months with Vive?
Oh, man. Okay. So in 2020, we did exactly one deal and we closed on $80 million. In 2021, we closed on $160 million. So we kind of doubled there and did two deals. So I think in 2022, we'll close on 3 deals maybe and get to 250 million-ish. I don't know. It's hard to say because we're just very patient investors too, which is why we don't do that many deals. And it's why we have a lot of competition for investors to get into our deals. We're only willing to put our name and our brand and our reputation on very, very specific deals that are solid, that will do really well through a downturn or pullback in the market. And so at this point in the market cycle, we've kind of shifted strategically to that. So I'd like to say we'll do 250 to 300 million, maybe a little bit more if we find enough great deals, but I don't know that we will. So.
Okay. Well, it's growth. It's moving in that direction, and you are, you're looking to also make sure that you're focused on the right deals for the right investors, which I think is something that is absolutely fantastic. So, just one last thing, because so we talked about kind of how if someone was looking to passively invest, how they would reach out to or find out more about the operators. But as a syndicator, as a successful syndicator who's looking for a very specific type of asset to help a very specific type of investor, what have you found that are the best ways for you to connect with the absolute right operator in a specific location?
As the LP?
Well, no, as the general partner, right? So when you're bringing it, and depending on if you're doing it as a vertically integrated, like you're doing everything from the syndication to the operations, or if you're syndicating when you're looking for the right operator in a specific location, whether that be in Florida or Georgia or in Texas? Because even though we're using technology, like how do you, what have you found that makes the right combination for an operator if you are in fact using or working with an operator that's not yourself?
Yeah, so
hopefully that makes sense.
Yeah, no, I understand what you're asking. You're asking how do you find a JV partner that fits kind of, whether they're operating and you're raising capital on the equity side. I understand.
Right.
So we actually do everything in-house A to Z. So we touch all aspects of the business. I'm way too much of a control freak to allow investor capital to go into someone else's deal and not be able to control it, because for us, our company is entirely 100% investor focused. So every decision we make starts and ends with how it affects the investors and if it's in the best interest of investors. So I just don't feel comfortable putting our investors into someone else's deal where we have absolutely no control or no visibility into the operations. Because execution is the hardest part. It's not actually acquiring the assets, executing on the business plan and delivering the returns that you are planning to deliver. So we don't find partners in different markets to work with, but I do have a JV partner on our Atlanta deals. We launched a $100 million value add equity fund for multifamily and other asset classes. But when we launched that JV partnership, we had partnered together in smaller capacities across many other assets. So this is now like our 6th or 7th deal we just closed in Q4 of 2021. And so I look for someone else who can complement what we do, but we have the capability to do everything in-house, because the reality is if you don't have that ability, what happens if you need to step in and operate and you can't operate? And so that's where it's a little bit more challenging for me to give up that, again, control. Like, I think that's like the theme of this podcast.
Yeah, and this is the thing and this is another thing that I want the entire Going Long family to recognize is the beauty of this real asset space is that a lot of it is really, it has to be in line with what you are trying to achieve. Right. And so, Veena, you've come through that over and over. And a lot of the reasons that most people get into real asset investing is because we want to have more control. That control can take on very many different forms. The most important thing is that you have to be, or you should be, operating in a model, whether it's the active investor or the passive investor, that is aligned with who you are and what you want to be able to achieve in terms of benefits. And this is just another example, which I appreciate you giving to us. So it's awesome.
Absolutely. And I would also add to that is if you don't have the ability to operate, or you don't have the ability to stack the capital, or you don't have the ability to acquire assets, but you want to be active, to find a partner who aligns with the same goals and morals and ethics of your company, and then also really understand what roles and responsibility everybody is expected to be playing, and what happens if certain KPIs aren't being met. Is there a way for you to come in and take over? Can you hold each other accountable? And what happens in the event of it not working out, especially if it's a new relationship? That, I think, is the way to kind of enter into it if you can't do A to Z in-house.
Great point. Love it. We're going to put a pin in it, leave that one there. And we're going to get ready and get into the Going Long Final 3. But Veena, the thing is, I never ask anybody the Going Long Final 3 unless you tell me, because today you are our special guest, that you're ready for me to ask you the Going Long Final 3. Are you ready?
Okay, I'm going to warm up. I think I'm ready.
Why do I know that you were absolutely born ready? So here we go. So here's the thing. We started with you over in Frisco, so just in northern Dallas. And so I want to be able to bring it back now to this side of the pond where I live over here in Europe. And so share with us, please, what is your favorite European city that you've either visited or is still on your bucket list to visit?
Oh my gosh, this is like so easy for me. It's Paris, hands down, always Paris. We used to go there every year, every other year, pre-pandemic. And I'm a fan for Chanel and Hermes. And so for me, it's like my Mecca. The food is amazing and we're big foodies. So Paris for sure.
Yeah, Paris is an amazing city. I started my 1-year sabbatical 20 years ago in Paris. And so, yes, very amazing things can happen in Paris. It's one of my favorites as well, although I love Barcelona now. But listen, so here's the thing. So the second question really has to do with a lot of the things that I have learned from being able to interact with very successful people. And I consider you to be someone who's very successful as well, many different aspects of life. And one of the things I've noticed, Veena, is that very successful people tend to be successful because they, unlike most people, they get it right the first time and they don't make mistakes, which allows them to actually accelerate. And that happens to me all the time. I get like, I want to go down this track and then I get all anyway, no, never mind. Veena, it's an inside joke. It's an inside joke with me and the entire Going Long family. This happens all the time. But the reality is, here's reality. So all jokes aside, people that are very successful make mistakes. Actually, they make a lot more mistakes than most people, like a whole lot more mistakes. But the reality is, very successful people, they really do one thing very differently that I've at least seen. And that is, especially for those mistakes or learning opportunities or whatever you want to call them, Veena, whenever they're relevant, they always take time to learn from the mistake or from the learning opportunity. And then they put tactics in place to minimize the probability of that exact same thing happening again. Mm-hmm. So what I'd love for you to share is if you can think about that learning opportunity, that mistake, however you want to call it. But most importantly, what is the one lesson that you took away from that incident that you know that the Going Long family needs to hear today?
Oh gosh, I have so many. Like you said,
just one.
I know, so many. Okay, so I'll speak as a passive investor, right? Because a lot of the listeners are probably going to be more on the passive side, and I invest passively into deals as well. So I think one of the deals that I had invested into as a passive investor had a structure that did not actually align with the GP. So the GP, or the general partner on the deal, the sponsor on the deal, had a different alignment to the deal than the example we had used earlier. And on paper, initially, when you look at it, it seems like it's actually a better split, because instead of getting only 70% of the deal, I was taking 80 or 85, I can't remember exactly, but 80 or 85%. And I was like, oh, wow, this is pretty good. I looked at the pro forma. And what I didn't realize at the time, because real estate had just been going up and up and up, but when COVID hit, there was a little bit of a strain on the multifamily market, especially in this specific asset. And so we ended up getting less cash flow. And what happened was the sponsor was not incentivized properly or enough to continue operating that asset to the absolute highest. And I'm not saying that they didn't, but their incentive now became to go after that next deal and get into the next deal versus focusing on the asset that they already have. And so I did not realize how big of a difference it actually makes to have the proper deal structure, even though the projected returns may seem higher. They're projections. And so if you can't deliver on them, it doesn't actually matter whether or not you are getting a projected higher or lower return. It's who can actually deliver on what they say they're going to do. And so looking back, as a passive investor and as an active investor, I spend a lot of time looking at deal structure. On the active side, I spend a lot of time learning, understanding, and trying to tweak deal structures to make it be that kind of perfect blend of what is beneficial to investors, what makes most sense for the deal, and what allows us to operate at maximum efficiency. So I think deal structure is very important regardless of which side of the coin you're on.
And so this is fantastic, because this is another thing. I mean, you gave us a great example earlier just to understand how the alignment happens. And then once again, just keeping in mind for the entire Going Long family, the importance of deal structure and being able to ask those questions so that you fully understand where the incentives are for the deal sponsors, as well as you specifically in this example, because we're talking about limited partners or someone who is actually placing capital, the things that you should be aware of. So thank you very much for sharing that with us. And then that takes us into the Going Long final three, the third and the last one. This is really about helping us feed our brains, Veena. So if you could help us understand, what is the one book that you would recommend to the Going Long family today?
Okay, so I'm going to go like out of the norm of what most like real estate investors read, you know, the basics, like The Millionaire Next Door, all those books. I'm going to go out of that, and I'm actually going to share a book that I'm rereading for like the second or third time now, but I really enjoy it. It's by Malcolm Gladwell. It's called Outliers. And it really talks about how influential like little outliers can be in determining major outcomes or bigger outcomes. And I actually enjoy books like that more so than even real estate investing books, because it is more of a mindset and it helps you understand how you can think of things on a more global aspect. So that's how I like to read personally. So I think that's a good book. If you haven't read it yet, you definitely should. I don't know, it's my favorite book, but I'm rereading it. So that says something.
Yeah, it's a fantastic book, Outliers. And also too, when you start thinking about those 10,000 hours, I believe we talk about over and over, and being able to develop mastery. It's one of those books that's definitely impactful. So thank you for sharing that with us, Veena. And, every single conversation, like these conversations go by so fast. And especially when you're speaking to someone like you that has so much experience and different stories that you can share with us and giving us specific examples. I mean, you started out in the very beginning talking to us about the positive things, like you getting a great night's sleep because you're 2.5-year-old. Well, they were doing what they needed to do, is that was sleeping. And so that was awesome. Being raised around a family that had real estate in the portfolio. Also, even though the great benefits and having control you were able to see from your parents, they knew you well enough to know that you needed to go out and do your own thing. And you got your finance degree and then started working for somebody else in real estate, watching them make massive returns and all that stuff. And then you're kind of like, hang on a second, maybe I should just go back to doing what I saw back at home. Got involved in the property management, started then to invest, had this negative experience that you and your husband were like, hang on a second, we're making a lot of money and we're paying a lot in taxes. We got to do something differently. Mom said, hey, listen, look for some more tax efficient stuff. You should probably check out this real estate. And then since then, not only have you made the decision for yourself, for your family, but you've also now been able to help other people. You talked about a lot of different doctors that are part of your network and part of your investor network. And I think that's absolutely fantastic. You've even taken it to another level where you are not just in Texas, you're in multiple states, and being able to bring new opportunities to investors regardless of the location, because you have the systems in place and you have your specific criteria. And I know that so many people that are part of the Going Long family are like, wow, Veena's really got this whole thing going on. I want to find out more about what she's doing with Vive, find out how I can get educated, find out about, how we can get in touch, maybe get on a phone call. So help us understand, what is the best way for the Going Long family to find out more about what you're doing, Veena, find out more about what's happening at Vive, and so they can get in touch?
Yeah, so you can go to my website. It's vivefunds.com, VIVEFUNDS.com. I have an investor portal. We put all of our new offerings in there, so you can watch our conference calls, see our OM, check out our PPMs, see everything from an investor perspective. And then, I'm on all the social medias as Veena Jetti, VEENAJETTI. So you can find me on like Instagram and Twitter and all of them. I'm everywhere. So.
All right. Fantastic. Well, Veena, listen, I just want to say on behalf of the entire Going Long family, thank you so very much for investing your time with me and with us. And thank you very much from the bottom of my heart. Really, really appreciate that.
Thank you. Thank you for having me.
All right. Fantastic. And if you give me just a second, Veena, because I always love being able to talk to the Going Long family just very quickly. Listen, Going Long family, Veena just once again, left so much value and really helped you, gave you very specific examples, and even gave you the opportunity to reach out to her. So you know what? Take her up on it. I've been over to vivefunds.com. Fantastic. Lots of information, lots of education, and really looking to help you to continue to move forward and do that much faster. So I know that I'm looking forward to welcoming you back on the very next conversation. So until then, go out and make it a great day. And thank you very, very much. Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long-distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you like today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.